Hello, I'm Peter Kinkaide. I'm the CEO of Raintree Wealth Management, and I'm excited to present today the Raintree Wealth Management platform. Just first off, who is Raintree Wealth Management? Well, Raintree Wealth Management is part of the Raintree Capital group of companies. Raintree was started in 2010, and it's based in Edmonton, Alberta, with offices in Toronto as well. We're part of an affiliate group of companies that includes corporate finance and investment banking. It includes private capital, insurance, life insurance, as well as wealth management services, which is what I'm going to talk to you about today. And collectively, we've helped place just under $2 billion of capital for clients across the country. Raintree Wealth Management is a portfolio management company. And so what we provide is discretionary portfolio management services. Those services are designed to help clients invest their money in traditional securities, stocks and bonds. And we do that on your behalf. And so we get to understand our clients and we get to learn about what your objectives are. And then we create a portfolio customized to your objectives and your risk tolerance. And then we actively manage that portfolio. So where that's a little bit different than maybe some of the other traditional advisory arrangements in Canada, where you have a stockbroker or an investment advisor who needs to receive your instructions before you make your investment decisions, we actually take on that role. And we make those decisions on your behalf on a proactive basis. And then we report to you about how we've performed or how the portfolios have performed, any fees and other information, including our outlook about what's coming next and how do we have the portfolios positioned moving forward. We have a team in both Edmonton and Toronto to support our clients across the country. Myself, I'm the Chief Executive Officer. I was a founder of Raintree Wealth Management, and I've been with the company, with a group of companies for over 10 years now. We have a team to support our clients, whether that's through cash management and those sorts of things. And of course, we have our investment management team. And I'll talk a little bit more about our investment committee and how we make investment decisions for our clients. There are three things that really define Raintree Wealth Management. First of all, we have the conviction to be different. You are not going to get just a traditional 60-40 set it and forget it portfolio with us. We're very actively involved in the investment making decisions and asset allocation for our clients. And we're willing to be different than the index. So we're not just going to closet index or hug the benchmark. We believe there are times where you want to be overweight certain markets or certain strategies and underweight, and we make those decisions on your behalf. Next, we invest globally. Canada is a small part of the global economic profile. We represent only 3% of GDP globally. And so it's important for us to give exposure to other markets, including the United States, of course, but also Europe, emerging markets. We really want to be globally minded in terms of setting that asset allocation. And then finally, valuations matter to us. So when we think markets are overvalued, you're going to see us trim our exposure to those. And when we think they're undervalued, we're going to be adding to those positions. Today is an interesting time where valuations are starting to really matter again. And you're seeing pullback in certain markets, and we're seeing repositioning globally as bonds and stocks are weathering some trying conditions. And so really being clear about how we value markets and the way we think about valuing markets is really important. And we've always had a longer term vision for how we value markets. And we're thinking about valuations in 5 to 10 year increments versus just day to day. And so it's important that we think and contribute our knowledge and our thoughts on valuation into the portfolios themselves. How we design portfolios, taking those philosophies in mind, is really important. So You have risk as a key driver of portfolio design. And again, in today's market, really understanding risk and where risk is coming from in the market is so important. And so we start with risk management as a driving design criteria. Next is that long-term thinking that I spoke about. So when we look at valuations, we're thinking about valuations and expected returns on certain asset classes for the next 5 to 10 years, not day to day. And we take a real discipline to that. So, one of the challenges, and especially over this last 2 years, is how much we see emotions creeping into investment decision making, and a certain amount of euphoria when people are buying things like GameStop stock or meme stocks or cryptocurrencies. And it's not to say that any one of those things is bad or wrong, but having a real discipline about how we make those decisions and rooting those decisions back into the math and numbers rather than chasing the herd is really important to us. And as I said before, we're active managers. So we're constantly looking at our portfolios and we're thinking about changing the composition of our portfolios and rotating them in and out of markets that we think are expensive or less expensive and cheap in a way that we think will add long-term value for our clients. And so at the end of the day, our clients end up with a really robust, diversified portfolio that includes all sorts of asset classes into the mix at any given time that allow our clients to really diversify their portfolios, and may even include some of the external types of investments that clients may be thinking about adding to their portfolios, including private and alternative investments through our affiliate company, Raintree Financial Solutions. And we also have created constraints on our portfolio. So we can't be all or none. It's not 0 or 100% cash. It's not 0 or 100% equities. It's creating ranges that we can operate in and then being able to rebalance within those. So even as it relates to, let's say, equities here, we have Canada, US, global, and emerging markets, plus our tactical strategies. We will be repositioning. They're not necessarily equal weights. Sometimes we're overweight certain markets over others. Currently, we're underweight the United States, as we think their valuations of US equity valuations have been very high compared to the rest of the globe. Fixed income and diversifying strategies as well help us balance out the portfolio, and particularly diversifying strategies, which include what we call market neutral exposure, meaning looking to make returns, whether the markets are going up and down, or even using cash as an important diversifier, especially at times like these where stocks and bonds have been going down in value at the same time. From an investment execution perspective, we then go on to hire other investment firms that actually make the stock selection decisions. And so we set the broad-based asset allocation for our clients, and then we go and we choose actively the investment managers that we think are most skilled at different areas of the portfolio. And as you can see, these are 4 investment managers, all headquartered here in Canada, that provide the exposure to different markets, including the Canadian equities market, tactical returns, which is a more active strategy, and you'll see rotate investments much more rapidly. Our international equities, including the United States, and global fixed income, and then the absolute return strategies that we use. And within that, to give you a sense of the type of investment advisors or managers that we use, sub-advisors we call them, well, I'm going to profile 2. So first of all, we have Q Wealth Partners. Q Wealth is headquartered in Toronto. They have their management team is led by a gentleman named Larry Berman. Larry, actually, you may have seen him on BNN. and he's had the longest running program there. But what's unique about Larry and his team is they're very, very active managers. They're rotating their portfolios very often, playing off of some of the same valuation metrics that I talked about earlier in terms of trying to buy markets that are less expensive and even stocks that are less expensive, and rotate and sell product investments that are more expensive. But they do that in sort of 50 to 200-day increments, thinking about it in those types of short-term timelines versus our more 5 to 10-year measurement in terms of valuations. And that provides an important diversifier into the portfolios, which we think really helps. And then Polar Asset Management is very unique as well, in that they take what we call a market neutral or absolute return exposure, where they'll buy securities and sell short securities in different pair trades. And you can see here that over time, those strategies have really improved returns against their benchmark, being the S&P 500. And what we think is unique about these is really around market timing. So these strategies did not perform nearly as well as the market over the last 2 years, but they really insulate the portfolios, or intended to insulate the portfolios, when conditions get worse. So whereas the equity markets, depending on the S&P 500 or Canadian equity markets, are down, Canadian 10%, S&P over 20%, and even the NASDAQ over 30%. The Polar portfolios have performed in the down 1 or 2% this year so far. So really mollifies or reduces the amount of downside that the portfolio itself experiences. And then we expect over time, as markets do, have these very large swings, new opportunities are created to generate returns. And that's really where Polar's focus is looking to generate positive returns in those conditions. So our wealth management investment committee is composed of 3 people. We meet at minimum quarterly to reset our asset allocation. Myself, as I mentioned, I've been with the firm for 10 years, and I've been an investment professional for over 20 years. Jay Bhutani joined our team recently. He's been in the industry for over 20 years. And then Adrian Morgan, same story, about a 20-year career in the financial services and investment business. So we bring our expertise and our valuation model to set the asset allocation. And then we have access to a tremendous amount of experience also with our sub-advisors. So when we want to know what our sub-advisors are thinking, we can pick up the phone or have a webinar, or even for Jay and Adrian, walk down the street and meet with those professionals and get a sense of what they're seeing in the market. For example, fixed income, it's been a really interesting asset class under a lot of pressure, and being able to have a conversation with the folks at Gordon and Payne about how they see the world and how they see the investment market really helps to for us to define our asset allocation strategy moving forward. So you can see performance year to date to April 30th. We are down, but not nearly as down as the markets themselves. This blended benchmark also benefits from a strong Canadian market, which has since deteriorated a little bit. And so our goal right now is really around preservation of capital. We have the portfolios defensively positioned. We really started that last year to heighten our positioning on the defensive side. And that included going up to 10% cash in the portfolio to wait for better times to invest. And that's really helped us this year. From a risk versus return perspective, these Sharpe ratios are a measure of how portfolios perform against their benchmarks. And so what we're trying to do is create additional return versus the amount of volatility that the portfolios are taking on. And so, as you can see, we've had better than benchmark Sharpe ratio since our inception. And that's a key focus for us, is making sure that the amount of return for the amount of risk our clients are taking on is in a positive ratio. And certainly we've shown that it has been to date. Also, limiting the amount of drawdown is very important to us. And so the amount of exposure to downside that our clients receive in our portfolios has been quite limited. As you can see here, the last time we had a large drawdown, so that means the markets are going down and the portfolio benchmark is going down. And this happened at the beginning of COVID. You can see that in our portfolios went down far less than their benchmarks. That's really based on our valuation approach and the type of investment strategies that we employ in the portfolio. And the same thing around volatility. You can see that our benchmark volatility is far higher than the volatility that we're exposed to in our portfolio strategies and our models. So really important that we uphold risk management as a key tenet to our portfolios. We also have transparent pricing. So in terms of what our clients pay us, our portfolio management fees start at 1.7%. Part of that goes to Raintree Wealth Management for the investment management services. And then another component goes to the advisors that are making introductions to us and providing some of the financial planning services to their clients. You can see those fees ratchet down as the client assets go up. And these are household levels. So it's not 1.7 on the first 500 and then 1.5 on the next. Once you hit a certain level, that becomes your fee. There are also fund costs and what we call expenses related to the trading and operations of the investments that we manage for our clients. And those are targeted to be 45 basis points on our clients' behalf. From a communication perspective, you can expect from us a quarterly account statement with commentary, semi-annual investment committee webinar, and an ad hoc videos that provide updates that are topical for our clients. That last part, I think, is really important. When the going gets tough, we've really tried to accelerate the amount of client communication that we're providing for our clients. When we see things going on in the markets, we really try and ratchet up that communication so our clients understand not only what we see, but also what we're doing about it on their behalf. That happened during the first part of COVID and has accelerated here this year in 2022 as the markets have seen a significant downstroke. Your client assets are held at Fidelity Investments, which is, or Fidelity Clearing, which is a custodian. They manage over $1 trillion globally. And so what you do as a client is you provide us with the instructions to be able to instruct your accounts and access to your accounts to trade those accounts through our investments. And so we don't take in your money. It's managed by a third party or it's held by a third party. And I think that's really, it can be a lot of comfort to clients that they understand where their investments are and they're managed by a very large or held by a very large organization. So next steps, if you're interested in learning more about Raintree Wealth Management, please complete our client questionnaire. That gives us good access to understanding who you are and what your objectives are. It's so important that we understand those things before we provide our advice to you and before we allocate you into one of the Raintree portfolio models. Then we'd schedule a call with the portfolio manager to go through that information and set what's called your investment policy statement. And after that, we do an onboarding where you sign all the package. Everything's done electronically these days. And we begin to initiate the requisition of your investments from wherever they're held today. If you have any further questions about this, please don't hesitate to reach out to us or speak to a Raintree private wealth advisor about whether our services might be the right fit for you. Thanks so much for watching.